Thing. As you can hear, I'm not too pleased with what's going on in Washington. We got CNBC Ace reporter Rick Santelli. We have Mike Ozanian of Forbes magazine, and we have our pal Mark Walsh. He's the founder, CEO of Air America, currently hosting the Sirius radio show Left Jab. Rick Santelli, this is virtually a Fed dictatorship. That's the way I look at it. Am I being too hard? I don't think so. And they broke it. They haven't earned this thing. They screwed up on monetary policy. This is twice, Rick. The tech bubble 10 years ago, now this crazy bubble. They can't stabilize the value of money, and we want to give them authority over all systemic risk? I think this is insane. Where are you coming out on this?
Listen, Larry, even if we gave them the authority, do you think that when it comes to crunch time that they are going to pull the plug? Listen, you know, I read these 85 pages, and it was hard to get through. But the point is there's many areas in this paper where they describe situations where we could never have made a difference, like CDSs. Hey, we recognize that. I remember in 02 and 03, 04, there were stories, Larry, that the paperwork for these CDSs and over-the-counter derivatives were 2, 3, 4 months in arrears. Everybody saw this coming. It's not the issue of visibility. It's the issue of taking the tough job when everybody's swinging from the chandelier to say it's last call. And that's the issue. And regulating and creating superstructures of regulations, you know it's not going to make a difference. They're not going to see the next one. They should regulate products. Have a menu. If you're this type of institution,
that's good.
Yes,
that's
transparency.
Good. Make them trade on, make the derivatives trade on public markets. I like that. By the way, that wasn't in Geithner's plan.
Well, I didn't see anything really about derivatives till about page 44, 45, and then they leave these loopholes, and I know this isn't the final form, but standardized versus custom CDSs. Listen, if you give a banker or an entrepreneur or capitalist a way to move it back out of the regulated exchanges, they will. You can't allow them to do that. You can't have bilateral clearing under any conditions unless the institution can fail, and I don't feel the ripples rising up on the shore.
Now, we're going to come back to you about this outrageous, what is it, $101 billion financing coming up. I want to go to my friend.
$104 billion, $3 billion more than the last time we looked at 2s, 5s, and 7s.
Unbelievable. Talk about the need for limits, for God's sakes. But Mark Walsh, look, a good liberal doesn't like a dictatorship. You know that Rick Santelli is right. If they're the systemic risk supervisor of all the big banks, they will never make money stable and scarce. They'll be afraid to tighten. We're going to have another. They're laying the groundwork for yet a third bubblehead in the last 10 or 12 years. Mark, you can't buy into this, can you?
I can buy into part of it, Larry. Now, remember, you believe in ownership society, and so do I. You believe in entrepreneurship, and so do I. You believe in prosperity, and so do I. And you believe in markets that are stable and transparent, and so do I. And I would argue right now, and I agree with parts of what Rick is saying, right now we are in an unstable, untransparent market, at least perceived by the overall marketplace. So we have to have a fresh perspective on regulation that is in place and regulated and enforced, because the last couple of bubbles, I would argue, just like Rick said, people made creative things and sold them to people that shouldn't have bought them. You're seeing a lack of liquidity. You're seeing a lack of confidence, and you may be arguing with whether Tim Geithner and Larry Summers are the right guy to do it, but the silos of regulation that we're not talking to each other. We had vertical regulation.
I'm not attacking Geithner and Summers directly. That's not my point. No. I am attacking the Fed.
Okay.
The Fed. Look, Mike Ozanian, the Fed from the early 80s to the late 90s, before the Y2K scam, had stable money. We called it the Great Moderation. We got inflation down. They used market price indicators like the dollar and gold and commodities and treasury bonds. Right. It was an unbelievable stock market rally along with the tax cuts. This has all gone away. People are forgetting that. We are going, go, stop. And when you give cheap money, what do you think traders are going to do?
That's the root cause of all
this.
this.
What do you think they're going to do? Zero interest rates is insanity.
They were the cause of the first oil bubble. They're the cause of this one. They've ignored gold. They should have been looking at gold originally. And look, what scares me about this, Larry, is Bernanke's so accommodating to Obama. He's blowing out the monetary base. He doesn't have the backbone of Volcker, who refused to do that for Reagan. He would not blow out the monetary base. He made it show up as direct deficit spending. This guy has no guts. If it was Volcker, I would still be uneasy, but I wouldn't be as frightened as I am today.
Where the heck do we want to put? This goes back to Rick's point. It's such an important point. The Federal Reserve has enough trouble figuring out monetary policy. This business about systemic risk regulation and all the bells and whistles, they're going to have hedge funds and probably private equity funds. They missed the whole credit crunch crisis in the first place.
They caused it.
And they did cause it. Then they missed it. They don't deserve this thing. We're still in the moral hazard business. You know, Volcker's article in the Wall Street Journal, Volcker said, no one is saying we will not continue to bail out banks. Bailout Nation is alive and well, as far as I can tell from Geithner's testimony, and I don't like Bailout Nation one bit.
Yes, it is, and that's why gold's at $940 an ounce, because they know that he's going to blow out the monetary base. He's going to devalue the dollar, and unless we get back to King Dollar, we're never going to have a full-fledged recovery.
King Dollar, that is the deal. Now, Rick Santelli, I want you to tell me about this. What is it? $104 billion borrowing?
40 billion twos, 37 billion fives, 27 billion sevens.
Rick, this is completely out of control. This is utterly out of control. It absolutely boggles the mind. There is no exit strategy from this. This is part and parcel of the whole. Nobody mentioned this today in the hearings, just like nobody mentioned free enterprise, nobody mentioned economic growth, nobody mentioned incentives for entrepreneurs. But what about this? This is not a small thing.
No, and Larry, keep in mind that the polls are now showing that the public is highly aware and not very comfortable with deficits and spending. And I think what we need to continue doing is, in a very balanced way, demonstrate exactly how large trillions are. Demonstrate, as Mr. Jack Welch said this morning, that if our growth estimates are off just a smidge, you're going to end up adding more hundreds of billions over the next 10 years on the out years. We have to assume lower than expected growth and hope for better. And if you assume 2%, boy, the numbers are much larger.
There's no limits, Rick. You know what the deal is? There's no limits. It's a theme of mine. We're not limiting spending. We're not limiting borrowing. We're not limiting debt.
Larry,
when
this TARP money comes back,
there is no
when this TARP
limits.
money comes back, is it going to go back to the taxpayer? No. What's the big debate where it's going to go? What did the senators say today when they were talking to Mr. Geithner on the Hill? They said it's a TARP slush fund.
You can't limit spending when there's a recession. You guys have to spend. Why are you guys talking about limiting spending now?
We're not talking about limiting spending. We're talking about drawing a line on what's sane and what's insane.
But you have to get liquidity back in the market. 2/3 of liquidity comes from securities market.
You know what? There's not a liquidity problem. There is a credit problem. This has been the mistaken identification of this issue going back to May of 2007.
I disagree completely. It is a liquidity problem. You have to get government money back in the market to get banks lending again.
It's over.
Banks lending to who? Who are they going to lend to, sir?
To businesses that are not getting lending now.
I hear all these stories about LIBOR. Gee, why aren't banks lending to banks? Listen, in America, banks should lend to who, Larry?
They ought to lend to customers and businesses who can qualify with a credit rating. You see, Mark, the point you're missing is the initial flurry has been taken care of. We've already poured hundreds of billions. Now, somebody has got to say to taxpayers and voters that we are going to establish limits to this governmental explosion, to this fiscal nymphomania. The popes want limits. Look at what the polls are saying. But I want to ask you about this, Mark. Here's some stuff that wasn't here. No issues with the rating agencies, who were one of the chief culprits. Geithner never mentioned. This is from Barry Ritholtz's excellent blog today, and I give credit. Nothing about the rating agencies.
No, but they constantly quote that everything has to be good, high quality, this and that. Who's going to determine good, high quality?
Hey, guys,
and Mark, I got a second one you can weigh in. From Ritholtz's excellent blog. We used to have a leverage ratio of 12 to 1. Right. That was thrown out by the stupid SEC in 2004. In one of the dumbest regulatory decisions in the history of the earth. But Geithner never mentioned that. In other words, if the Federal Reserve is going to be the systemic risk regulator, which I hope they won't, I want Sheila Bair's FDIC, why not reinstitute the leverage standards? Because leverage was one of the poison pills in this whole story, Mark.
I might shock you guys. This is coming from a liberal, but I agree with both points. Standard & Poor's and the regulatory agencies should have been way more harshly treated in Geithner's report. In fact, they got a slap in the wrist, and the cookie jar is still open. I completely agree that regulatory agencies who are funded by their customers should be taken down a notch and taken out of that economic disincentive to be mean to their customers because they're funded by them. And number two, I agree with your second point, which is that the FDIC should be looking very much at this ratio that was taken down in 2004. I agree with both your points, Larry.
All right, good work, Mark Walsh. Mike Ozanian, let me just finish with you. We don't have enough time tonight to do it justice, but we did have some positive economic news. All this monetary stimulus, if they ever have an exit strategy, which I'm worried about. But leading indicators up the second month in a row, a huge gain. The 6-month growth rate of the LEI has now turned positive. The 4-week moving average of unemployment claims way down. And also, the Philly Fed Manufacturing Index is now showing a tremendous, I believe their 6-month outlook is up 60 points from the bottom. Now, these are good recovery signs. Right. This is another reason why I think the Fed is about to give us another bubblehead unless they give us an exit strategy.
Good mustard seeds, and all the money they're pouring in, Larry, isn't doing any good because the velocity of money is still way below 1. And that's what's scaring people is the huge deficit spending. We're going to spend 3.6 times more this year than we did in 2008. And that's what's killing the economy.